Hey, what's going on, y'all? What's going on, y'all? Hopefully you got a lot of knowledge from the first three parts of the course. Um, I really, took some time to really put that together. A friend of mine, G Cole. So the knowledge that you're getting from there, it's not something that you have to have like in your pocket type knowledge, but it is very, very useful. Throughout the year, people ask me a lot of questions. So then what I'll do is I'll give them the answers based on that. You know what I'm saying? So that's what it'll usually be. So what I'm gonna do is I'm gonna finish doing that, and then I'm gonna finish going over what we have is the income section. That's part one, part two, and part three. So I'm gonna go ahead and allow you all to go ahead and start that. The first section, I believe, goes into IRA accounts. IRA accounts. Let me see. Actually, matter of fact, no, it doesn't actually. But let's see. Let's see what we have here. So first part is actually going to go over common types of income. So give me one moment. I'm going to go ahead and get that started for you all. Give me one moment.
Professionals. We are now in the fifth module and we will dive into an essential topic, common types of income. As tax professionals, it's crucial to have a solid understanding of the different types of income your clients may encounter. By familiarizing yourself with these income categories, you could accurately report and advise your clients on their tax obligations. Income can come in various forms, and each type may have different tax implications. Let's explore some of the most common types of income you're likely to encounter when preparing tax returns. Understanding these categories will help you navigate the complexities of the tax code and ensure accurate reporting. Let's start to know them all. Income, in the context of taxation, refers to the total amount of money, goods, property, and services received by an individual that is domestic and international. When we talk about gross income, we are referring to the total income received by an individual before any deductions or exemptions outside the United States. It's important to note that even income that may be eligible for certain exclusions, such as income from the sale of a primary residence, still contributes to gross tax purposes. In some cases, specific types of income may be subject to received scholarship and fellowship grants are considered income and must be included in the calculation of gross income. Next, let's dive in the other taxable income. On this slide, we will dive into the various types of taxable income that individuals encounter when filing their tax returns. Let's explore two primary categories: earned income and unearned income. First, we for work or services provided, exemptions, tips, and bonuses. If you are self-employed or run a business, the income you generate from your entrepreneurial activities also falls under earned income. It's important to note that earned income is typically subject to federal income tax, as well as payroll taxes such as Social Security and Medicare. On the other hand, we have unearned income, which encompasses any income that is not derived from work or services. Unearned income includes various sources such as interest on savings accounts, dividends from investments, capital gains from the sale of assets, rental income, and royalties. Additionally, income from unemployment compensation, pensions, annuities, and certain government benefits may also be classified as unearned income. When it comes to reporting these different types of income, taxpayers generally use Form 1040 and its associated schedules. Earned income is reported on the appropriate lines of Form 1040, while specific types of unearned income may require additional schedules or forms. In our next session, let us know some examples of non-taxable or exempt income, so stay tuned. Non-taxable income refers to the types of income that are not subject to federal income tax. These income sources are considered exempt and are typically excluded from the taxpayer's taxable income when filing their tax return. Let's take a closer look at some common examples of non-taxable or exempt income. First, we have gifts and inheritances. If you receive a gift or inherit assets or money from a family member, friend, or other individuals, this type of income is generally not taxable. The donor or estate is responsible for any gift or estate taxes that may apply, but as the recipient, you do not have to report these amounts as taxable income on your tax return. Next, we have certain types of insurance proceeds. For example, life insurance proceeds received as a result of the death of the insured person are generally not taxable. This includes both the face value of the policy and any additional amounts paid out as a result of the policy's terms. However, it's important to note that any interest or investment gains on the insurance proceeds may be subject to tax. Additionally, some other examples of non-taxable income include certain veterans benefits, workers' compensation benefits, and certain public assistance benefits. These benefits are designed to provide financial support in specific circumstances and are typically exempt from federal income tax. It's worth mentioning that while these types of income are generally non-taxable, there may be specific circumstances or exceptions that could make them partially or fully taxable. As tax professionals, it's crucial to review the specific rules and regulations surrounding each type of income and ensure accurate reporting on the tax return. Next slide is the exempt income. Let's continue our journey toward tax expertise. Let's continue by exploring the concept of exempt income, specifically focusing on interest income produced from certain types of investments. Exempt income refers to the types of income that are not subject to federal income tax. While exempt income is shown on the return, it is not included in the income tax computation, meaning it does not increase your taxable income. Let's delve deeper into one common example of exempt income: tax-exempt municipal bond interest income. Tax-exempt municipal bond interest income refers to the interest earned from bonds issued by state or local governments. These bonds are typically used to finance public projects such as infrastructure development, schools, or hospitals. The interest income generated from these bonds is considered exempt from federal income tax. When you receive tax-exempt municipal bond interest income, it is important to report it on your tax return, specifically on Schedule B if applicable. However, this income is excluded from your taxable income, meaning it does not increase the amount of income on which you owe federal income tax. The purpose of reporting exempt income is to provide transparency and ensure accurate reporting to the IRS. It's worth noting that while tax-exempt municipal bond interest income is exempt from federal income tax, it may still be subject to state or local taxes depending on the laws of your specific jurisdiction. Therefore, it's important to consider any applicable state or local tax implications when assessing the overall tax impact of your investments. Let's now go to W-2. We will be discussing an essential component of many taxpayers' income: W-2 income. W-2 income refers to the taxable wages that you earn from performing job tasks for your employer. It's the income that is reported on your W-2 form, which you receive from your employer at the end of the year. When you work for an employer, they will typically withhold taxes from your paycheck based on your earnings. The amount of taxable wages you earn is determined after subtracting pre-tax deductions, such as contributions to retirement plans, health insurance premiums, or certain other eligible expenses. These pre-tax deductions help lower your taxable income, which in turn may reduce the amount of income tax you owe. Your W-2 form is a crucial document that provides information about your annual earnings and the taxes withheld throughout the year. It includes details such as your total wages, federal income tax withheld, Social Security and Medicare taxes, and any other applicable deductions or benefits. It is essential to carefully review your W-2 form for accuracy and ensure that it aligns with your records and earnings for the year. When you file your tax return, you will need to report your W-2 income on the appropriate forms, such as Form 1040 or Form 1040-A. This income is subject to federal income tax, and the tax liability is calculated based on your taxable income and applicable tax rates. How about the other W-2 income? Let's check it out together. Let's have the important aspect of W-2 income: disability pension. While W-2 income typically represents taxable wages earned from performing job tasks, there are certain situations where additional types of income can be reported on the W-2 form. One such example is a disability pension. If a taxpayer is receiving a disability pension but has not reached their employer's minimum retirement age, they may report this disability pension as wages for tax purposes. This means that the disability pension will be included in their W-2 income, and it can have implications for various tax considerations, such as the Earned Income Credit. The Earned Income Credit, EIC, is a valuable tax credit designed to assist low to moderate income individuals and families. It provides a financial boost by reducing the amount of tax owed or even resulting in a refund. However, to be eligible for the EIC, the taxpayer must have earned income, which typically refers to income from work. In the case of a disability pension reported as wages on the W-2 form, it can be considered as earned income for EIC purposes. Thank you for joining us. Stay tuned for more valuable information and helpful tips in the next section. Welcome to the Types of Income Part 2. Our focus in this segment is on the question, when can qualified Medicaid waiver payments be excluded from gross income? Let's start with a clear understanding of the rule. According to IRS guidelines, qualified Medicaid waiver payments may be excluded from gross income only when the care provider and the care recipient reside in the same home. Consider the implications of this statement. When our clients, the care providers, live with the care recipients, the payments they receive are not considered part of their taxable income. This can significantly impact their overall tax situation, presenting an opportunity for us as tax professionals to offer strategic advice. Now let's examine the other side of the coin. What happens if the care provider and the care recipient do not live together in the same home? The tax law clearly states that in these cases, the Medicaid waiver payments may not be excluded from gross income. This means that these payments are taxable and should be accounted for in the care provider's annual tax return. This rule is a striking example of how the nuances of tax laws can drastically impact our clients' financial situations and underscores our vital role in helping navigate these complex laws. As we progress, we'll continue to unpack these complexities, equipping ourselves to better serve our clients. Next, we shift our attention to an income category that often raises a myriad of questions. Tip income. Imagine you have clients who work in industries where tips are a significant part of their income. They might be waitresses or waiters, bellhops, hotel keepers, among others. How does tip income fit into the larger tax landscape? Here's the key point. All tip income is taxable. That's right. Whether your clients have reported these earnings to their employer or not, it remains a part of their gross income for tax purposes. This is an essential consideration for us as tax professionals when preparing returns or offering tax advice. So, whether it's the couple of extra dollars left at a restaurant or a generous tip given to a bellhop at a hotel, all these constitute tip income, and they must be reported on the tax return. Next, we're navigating through the labyrinth of non-cash tips and their implications on taxable income and Social Security and Medicare taxes. Firstly, it's crucial to remember that non-cash tips, such as tickets or passes, while not required to be reported to the employer, are nevertheless included as taxable income. This might seem counterintuitive, but the tax law is clear on this point. But here's where it gets even more interesting. Tips that are less than $20 per month or non-cash tips are not subject to Social Security and Medicare taxes. A very specific carve-out, don't you think? However, if our clients receive tips of more than $20 a month and have not reported these to their employer, they are liable to pay not just income tax on these amounts, but also Social Security and Medicare taxes. Now, this is where our guidance becomes invaluable to ensure they are both compliant and aware of their obligations. In this part, we're turning our focus to a less common but equally important aspect of taxable income: penal income. penal income refers to income that a taxpayer receives while in prison, a work release program, or a halfway house. Picture this. A client of yours, due to unforeseen circumstances, finds themselves in one of these situations and receives income. How should we as tax professionals handle this? First and foremost, the compensation they receive will be reported on a W-2 form. However, this is where it diverges from traditional income, not treated as earned income. So, where do we report it then? The amount is reported as wages on the Form 1040, but it's distinctly marked. It is shown as PRI on the dotted line next to the wages line. Now we delve into the realm of scholarship and fellowship income, a critical aspect for taxpayers in the academic world. Scholarships and fellowships can fall into three broad categories for tax purposes: fully taxable, partially taxable, or non-taxable. Sounds straightforward, right? However, let's take a closer look at what determines these categories. There are specific elements that contribute to the taxable amounts. These include any payment received for services. Additionally, money used for personal living expenses, such as room and board, also falls into the taxable category. Now, what if a taxpayer receives a W-2 form for the scholarship or fellowship? Well, in that case, it is considered earned income. This distinction is crucial and can impact the taxpayer's overall tax situation significantly. Understanding the tax implications of scholarship and fellowship income allows us as tax professionals to provide vital advice to our clients, particularly those in the academic field. Let's continue to expand our knowledge in these niche areas and strengthen our expertise. Now, let's explore taxable interest, a common yet multifaceted aspect of income in the world of taxation. We encounter taxable interest in various forms, and understanding these sources is crucial to providing our clients with accurate and effective tax advice. Common sources of taxable interest include checking and savings accounts. You see, while these accounts are typically used for storing and managing funds, the interest they generate must be reported as taxable income. But that's not all. Certificates of deposits and savings certificates also generate taxable interest. These are popular investment options, and their tax implications must be understood clearly. Next, we have U.S. government bonds. Yes, even these bonds, backed by the full faith and credit of the U.S. government, generate taxable interest. Interest on insurance proceeds, often overlooked, also falls under the taxable category. Lastly, loans that our clients make to others, the interest received from these personal loans is taxable as well. Now it's time to explore the other side of the coin, tax-exempt interest income. Yes, not all interest income is subject to federal income tax. Some of it enjoys a tax-exempt status, and understanding what falls into this category is integral to our work as tax professionals. So, what qualifies as tax-exempt interest income? Well, the interest from bonds issued by certain entities is exempt from federal income tax. These include bonds issued by states and their political subdivisions, such as a county or city. Similarly, interest from bonds issued by U.S. possessions and their political subdivisions also enjoy this tax-exempt status. This exemption can significantly influence the investment strategies of our clients, making these bonds an attractive investment option. All right, folks, let's continue exploring the question on what interest income is tax-exempt. Firstly, we're going to hit the road, quite literally. Did you know that toll road commissions can yield tax-exempt interest income? Yes, you heard right. Investments in bonds issued by toll road commissions are a smart choice for those looking to earn tax-exempt interest. Next up, we have utility service authorities. Investing in bonds or securities offered by these authorities can help you earn interest income that's immune from taxes. It's as if your investments are wearing an invisible tax shield. Moving forward, we arrive at community redevelopment agencies. These entities often issue bonds to fund their projects, and the interest earned from such investments typically falls under the umbrella of tax-exempt interest income. Quite a win-win, isn't it? You're indirectly contributing to community development while enjoying tax-exempt gains. Qualified volunteer fire departments. By investing in bonds issued by these entities, you're not just supporting a vital public service, but also earning interest income free of taxes. Lastly, let's not forget about those amounts indicated on broker statements as tax-exempt interest or tax-exempt dividends. If you're an investor, make sure you look out for these on your statements. They're your gateway to additional income that doesn't attract a tax liability. See you in the last section.
Sorry, y'all, I was on mute, but so that section is something that you'll probably want to watch again. It's very a lot of knowledge. It's not very common that you're going to run across all of those scenarios, but as you grow your book of business, you're going to want to know those scenarios because you're going to run into different type of clients. As you grow, you're going to want different types of clients because they pay different and they pay more. And those clients are going to come to you with some of those scenarios that we discussed in that. So the main thing is just obtaining this knowledge, keeping the knowledge. This is recorded, so there's no reason why you have to remember this on the fly or anything. You can't go back time until tax season, so you can go back and watch those. Or if you run into a scenario, it is okay to tell the client, "Hey, I'll get back to you. Let me just look this up a little bit." Just wanted to throw that out there before we begin our last session. This section, this is part 3 of the income section, um, and this will be the final part. Once again, once this is over, I will be sending you all an assessment. Um, Depending on if you guys want to watch the video, you'll have a week up until Thursday, Friday to go ahead and finish that, and whoever gets the best on that on my class next weekend, it will be free. So give me one moment. We'll go ahead and get that started.
Now, the term ordinary dividends might sound, well, ordinary, but understanding its nuances is essential for a well-rounded knowledge of income types. Ordinary dividends are the bread and butter of many investors' portfolios. They are distributions made by a corporation out of its earnings and profits. These distributions could be received on common or preferred stock and are typically referred to as ordinary dividends unless specified otherwise by the corporation. Now you might be wondering, how do we track these dividends? Well, they are neatly reported on Form 1099 DIV. Remember, understanding and effectively managing these ordinary dividends can significantly influence your client's tax scenario. Now let's talk about Section 199A dividends. These are not just a part of the wider family of ordinary dividends, but hold a special place due to their unique characteristics. The key feature that sets Section 199A dividends apart is their eligibility for the qualified business income deduction. Yes, you heard it right. This special category of dividends, named after the section of the tax code from which they originate, can indeed contribute to your client's tax savings through the benefit of this unique deduction. Section 199A dividends can serve as powerful tools in tax planning. Being able to accurately understand and leverage these dividends can help maximize tax efficiency for your clients. It is therefore imperative to identify these dividends correctly and make full use of their potential. As we continue our journey through the landscape of dividends, let's now turn our attention to qualified dividends. Just as the name suggests, qualified dividends are no ordinary dividends. They are, in fact, a subset of ordinary dividends, but they carry a special qualifier. What sets them apart is their eligibility for lower, long-term capital gains tax rates. That's right, folks, lower tax rates. As tax professionals, one of our key goals is to help clients retain more of their hard-earned income. This is where understanding qualified dividends becomes pivotal. Through proper planning and application of tax laws, the income received as qualified dividends can indeed be taxed at a more favorable long-term capital gains rate. The strategic use of this income type can lead to significant tax savings, making qualified dividends a key player in the game of tax efficiency. Next, let's explore the concept of capital gain distributions, also known as capital gain dividends. These might sound similar to some of the dividend types we've covered, but I assure you, they hold a distinct place in the tax ecosystem. Capital gain distributions primarily originate from mutual funds and real estate investment trusts, or REITs. These are unique entities that pool investor resources to invest in a variety of assets, and the profits from these investments are often returned to the investors in the form of capital gain distributions. Now, here's the exciting part. Capital gain distributions carry a sweet advantage for taxpayers. They are taxed at the lower long-term capital gains rate, regardless of the duration the taxpayer holds the shares. That's right. Whether your client has held the shares for a year or a day, the long-term capital gains rate applies. This can be a significant boon in terms of tax efficiency. Let's shift gears slightly as we now turn to a different type of income: alimony. Alimony is a payment made to or for a spouse or former spouse under a divorce or separation instrument. It may come as a lump sum or regular payments and typically serves to maintain the financial status of the spouse who was less monetarily active during the marriage. Importantly, alimony may include payments made on behalf of the spouse or former spouse. This means payments covering a range of expenses such as medical bills, housing costs, and other necessary costs can be categorized as alimony, with corresponding tax implications. However, it's crucial to note that alimony does not include child support or voluntary payments outside of the separation or divorce instrument. These are considered separate entities with their own unique tax considerations. Moving forward, let's discuss a form of income that has been highly relevant in recent years: unemployment compensation. Unemployment compensation is financial support given to individuals who have lost their jobs through no fault of their own. Now, the important part from a tax perspective is this: unemployment compensation is taxable. Yes, all these funds can be.
The 1099-G is a form that's very common. Um, and it's very commonly misplaced. Um, a lot of people will file before they receive that. So one of the key things to remember is that most of these businesses or companies or whatever, they have up until the 31st of January to send you these documents. I've had multiple clients who come and do everything so fast and just they don't forget that they're unemployed. They just want to do everything fast. And what'll happen is either one, it'll hold up the return. They'll get a letter saying or something saying that they didn't file their 1099-G. Two, they'll get the 1099-G in the mail. Then they got to come to me. Now I have to amend the return, and amending the return costs you 6 weeks before they process. So that's on the client. That's a failure on their end. And then sometimes with those amendments, the money may go straight to the client. So, you may want to honestly charge for that amendment, because that's really kind of on them. But unemployment compensation is very big. Even back in COVID, we know there was a lot of unemployment fraud. So you want to watch for these things. We had a lot of people who were getting unemployment forms who didn't even file. So you really want to watch out for fraud in these instances, but for the most part, you want to ask your client, were they unemployed? Did they get any unemployment? And if they don't have that form, they just need to go ahead and wait for it. All right.
A lifeline for many, it's crucial to remember that come tax time, this income needs to be reported. Furthermore, taxpayers may elect to have those taxes withheld for income tax purposes. This can help avoid a surprise tax bill at the end of the year. To facilitate this, recipients of unemployment compensation receive Form 1099-G to report this income. This document serves as a record of the compensation received and is critical for accurate tax filing. Now let's talk about another unique type of income: paid medical family leave. Paid family leave is a benefit that falls under state disability insurance programs. Workers covered by state disability insurance, or SDI, are automatically eligible for this benefit. This ensures that individuals who need to take time off to care for a family member with a serious health condition or to bond with a new child can do so without a significant financial burden. The maximum duration for which this benefit can be claimed is 6 weeks. But here's the key point from a tax perspective: this income is reported as unemployment on the individual's tax return. Yes, even though it's for paid leave, it's categorized as unemployment for tax reporting purposes. This is a key aspect that tax professionals need to be aware of when preparing returns that include paid medical family leave income. Stay with us as we delve into the finer details of reporting this income in our subsequent slides. As we end in our discussion, we come to a very important topic: Social Security benefits. Social Security benefits are a significant source of income for many, particularly the retired populace. They include monthly retirement benefits, survivor benefits, and disability benefits. However, it's worth noting that these benefits do not encompass supplemental security income or SSI payments. Importantly, these SSI payments aren't taxable. Now, the key to understanding the tax implications of Social Security benefits lies in the net amount that taxpayers receive. This amount is reported in Box 5 of Form SSA 1099, which is sent each year by the Social Security Administration. Remember, while Social Security benefits can provide financial stability, they also come with tax considerations that must be carefully understood and navigated. Thank you.
All right, y'all. So for the most part, with Social Security, what usually happen is they will bring their form. That's usually seniors. You got some people that are disabled. Some parents, they'll have that as far as their kids, and that will have to be included in the return. But for the most part, it is data entry when it comes down to Social Security and those type of things. It's pretty much data entry, and it can usually be very simple. I mean, you may get those people who, due to some stuff from the prior years or overpayment or whatever, they may owe due to that. But for the most part, it will be on the form, and they usually take the payments out of the Social Security, and all of that will be on the form. Just make sure that a lot of these clients they don't get really any return. So you want to kind of really be careful with those, and that's for your reputation because you don't want to be out here charging somebody elderly who just gets Social Security. You don't want to be out here just charging them crazy prices. And sometimes you might want to if they got somebody to bring with them, go ahead and rock them out for free real quick because it's very very quick. You know what I'm saying? And it'll be worth it for you in the long run to just go ahead and get them that referral fee right there, knock them out quick. And if they bring their grandchild or whatever, go ahead and assist them with that. But that was the income section. It's pretty brief, pretty quick. So what I want you guys to do is over the next couple of weeks, well, over the next week, because we have an advanced class next week. That is $99, but for the prepared, we'll send out that assessment. All I'm asking you to do, hey, go ahead and look back through these replays if you can. Get that assessment done and join us next Saturday because that's going to be super valuable. Um, and I say that because having that knowledge will definitely bring you a lot more money, and it'll just make it a smoother process, make you look like more of a professional when you're doing things. So I would heavily encourage you guys to join that class. Some other things that we'll be doing starting in December. I know that we'll be doing one weekly session, meeting up one time per week in the group. That's going to be very key because you guys go have questions. Do not wait until the end of December to start asking me questions because I'm going to charge you. All right, I'm giving you, these free courses. I'm giving you the game, but I'm going to charge it because I have to prepare myself for my stuff. So, for the most part, preparers, please get your P10s. Um, if you own an office, make sure your preparers have a P10. Make sure you submit your bank information that I put into the group. And if there's any questions, don't be afraid to ask in the group, inbox me, or ask in the comments on the videos. I will holler at y'all later.